Code 3 Americans, in a few short minutes, we're going to explain why the bond market matters, why when interest rates rise, bond values fall, and why you want to understand this so you can be watching the bond market, not the stock market. First key concept, bonds are simply debt. Governments or companies can issue a bond to raise capital with a predetermined amount of interest and for a predetermined amount of time. Here, we can look at the rates that current US Treasuries are bringing, and the term is on the left, and the rate essentially is in the middle. What you'll notice is for a long period of time, rates have been very flat at about zero. And then all of a sudden, in the effort to fight inflation, the Federal Reserve has taken a number of actions to raise rates, which when they raise their rates and do some other things they do, it also pulls up treasury rates and various other things. So you can go through here and see a number of bond rates, which here a 6-month T-bill brings about 4.7% annualized when it used to be zero. And it accelerated to that in a very short amount of time. I'll show you why that matters here in just a second. Next thing to understand about bonds is you hear people talk about the yield curve. Yield curves should slope upward from left to right. In other words, short-term yields are over here, or short-term terms, are over here, and longer-term terms are on the right. So in other words, it makes sense that if you were going to borrow money from a bank, they should charge you more to borrow money for an extended period of time than for a shorter period of time. This is because they are at risk. They're at further risk if you default on paying the bill or paying the loan amount for whatever reason, whether it's losing your job or whatever else. So they should require a higher premium for longer term loans. Bonds should be the same way. So in other words, a yield curve should slope upwards from left to right. However, if you'll notice the current yield curve, it's sloping downwards from left to right. That's not a sign of a healthy economy. So let's look here. The Federal Reserve, this is their Fed funds rate, was very flat relative to the pandemic, and then suddenly they raised rates at a very fast pace, which has taken these yields up very, very quickly. I'm going to show you why that matters. If you haven't already joined the Code 3 American community, I'm not sure what you're waiting for. Not only will you get our newsletters and other great content, you'll be among the first invited to join other Code 3 Americans for our online investor meetups where we feature great content and amazing guests. All Code 3 Americans are on a journey to build wealth for them and their family, and the community is a great place to do that. You can join for free by emailing community@code3assets.com. We'll see you inside. Let's take a look at how bonds work. First, we must look at then versus now. Interest rates were much, much lower not that long ago, and now they are much, much higher. So why does that matter? For the purposes of this example, let's assume we're talking about a 1-year bond for $100. So then in a low interest rate environment, let's assume bonds were bringing 2% yield. So in other words, somebody could earn $2 on their $100 if they held that bond for 1 year. This would mean they would need to pay $98 for that bond. That would give them the $2 yield at the end of the year, which is 2%. Well, that was then. Now, with interest rates much, much higher, let's say yields are currently 4%. Well, again, if somebody was wanting 4% yield, or if the market was bringing 4% yield, someone would have to pay $96 to get a $4 return in that year, which is 4%. So in other words, if somebody was holding a bond that they paid $98 for that would yield $2 in 1 year, or 2%, nobody would buy this bond when they could go to the market now and buy a better bond. So that's why when interest rates rise, bond values fall. And here it is. So what this person would have to do to sell that bond into the market when better bonds are now available is they would have to get the yield to $4. And the way they do that is they must now sell the bond for $96 instead of $98. This means they take a $2 haircut when they sell their current bond into the market. And if those bonds were once valued at $98 and now they drop to $96, that affects their balance sheet. So why does this matter? Well, a lot of bonds were issued in very low interest rate environments. So a lot of those bonds are used as collateral to get loans or to do various other things. And what happens is it's not like a house. If most people own a mortgage or have a mortgage with their house and their house value drops, the bank doesn't care so long as you keep paying the mortgage. However, that doesn't work like that when collateral is being put up on these types of loans in institutional, or when you're dealing with institutional money. So what happens is a lot of this collateral is pledged to get a loan. So if a bunch of people pledge $98 bonds as collateral to get loans, and now they're worth $96, the lender that gave them the cash and was holding that collateral to secure their loan position is going to give them a margin call, and they're going to call for $2. They want that collateral shored up. And this is happening a bunch right now. And this is a situation in with entities that may already be short on cash for whatever reason. Now they're getting these margin calls, which is for putting further strain on the balance sheet. What that does is it ultimately creates lack of confidence, which creates volatility in the market, and that volatility creates more lack of confidence. And this just sit here and it recircles and recircles. So that's why the bond values work inverse of the interest rate. So the reason you want to pay attention to that is the stock market or Wall Street does this all the time. There are a lot of margin calls that have been happening over the last number of months as interest rates have been going up steadily. So this is why you want to be looking at the bond market, not the stock market. The stock market's like looking in the rear view mirror while driving forward, while the bond market is telling you what is likely to come in the future. The other reason this is causing problems on Wall Street or in stocks, as more people can reach 4% yields or 4.5% yields, they have less desire to take more risk by owning stocks, which are equities, um, to get 7, 8, 9, 10% yield. When they could only get 1% with bonds, they would go out and take more risk to get a yield, to give them a higher yield towards whatever the inflation rate was. However, as this number gets higher, more money moves out of stocks and back into the bond market, which is another reason it's causing stress at Wall Street. So here's something you can do, a resource for you. If you don't know, you can go to Treasurydirect.gov. If you're looking for a place to park short-term cash, so in other words, if you want to be ready for opportunities in 2023, but you don't want to be sitting getting completely eroded by inflation in your cash positions, you could go here and buy T-bills, which are short-term treasuries, which are listed here. So you could buy a 3-month bill that brings about 4.4%, and you could have your money liquidated in 3 months so that you're not stuck with that for the very reasons we just described, so your bond values don't go up or down. If you're not looking to trade bonds to make a capital gain, if you're just looking for an interest rate yield and a place to park cash, you could certainly go to Treasurydirect.com. Pretty easy to set up an account to where you can buy those T-bills and have a place to park your short-term cash. Again, we don't give investment advice, just ideas and information, but that's a resource for you to use. If you want to learn more about what's going on with bonds and interest rates, as well as what caused 40-year high inflation and what the Fed is doing with bonds and interest rates to fight it, check out this video we created. It goes into all that detail.